Welcome to another episode of the Misfits of Real Estate. I have got Jen and Stacy Conkey on today, and we're going to dive into what they've been up to as far as investing in the multifamily space and capital raising. So without any further ado, let me bring them on. Hi, ladies. How are you?
Great. We're doing awesome. How are you?
Oh, doing good. Thank you so much for coming on the show.
Thanks for having us.
Yeah. So we usually just get started by having you give us a background on, how you got into real estate, why you love it, and, what you've been doing to get to where you are today.
Awesome. Okay. So we both started about 20 years ago, a little over 20 years ago, and separate paths. I think kind of came up the ranks the same way that most people who are in multifamily now do. Started with single families and flipping, and then going into plexes, and eventually into apartments, apartment buildings. And we ended up, I don't know, about 8.5 years ago.
Yeah.
Joining forces and, just building our multifamily from there. I feel like it's just kind of like the standard story of, figuring it out, making mistakes, refining things. Now we have a pretty smooth process and system.
Yeah. Well, I mean, you've been doing it for a long time, so you've seen ups and downs and everything. So maybe that should be the first thing that we kind of dive into. Like, how did you navigate those ups and downs, and any learning lessons?
Oh, a ton of lessons. You want to go first, or you want me to go? We have so many.
God, there's so many. You can go first.
I think that along the way of my journey, my very first lesson was in the beginning. It was my very first flip, and I did a lot of do-it-yourself. And I had my dad and my brother. They were a part of it with me, and we, for 7 months, tried to do a flip where I was literally pounding the tile floor myself, scraping popcorn off the ceiling. Just, it's not scalable. And I think that that's what I learned first, is it's not scalable. And on top of that, we didn't really know what we were doing because we're not licensed contractors. We don't know trade. And so we're not really producing quality work. And we made $1,500 profit in 7 months. So I learned a lot from that first project, and it just continues to scale from there in terms of lessons. I think the next biggest lesson, I lost $80,000 in a single day because I decided to not do an inspection early on in my career, and found out that it had post and pier foundation. And that's very expensive. Apparently you have to get a structural engineer to lift everything up and come pour new concrete. And I ended up selling that property at a loss. And there's just so many little things that in the beginning, that first 2 years, where trying to go for it and figure it out, it didn't work out very well for me, other than I learned a lot, and now I can share it and pay it forward so that you don't make that mistake. You know what I mean? I know you have a couple, or at least one.
At least 100. I think for me, one of my biggest lessons, Mark, came when 2008 came and knocked a lot of people out of the game, including me, for a while. And one of the big lessons out of that whole thing was, for me, I was very much bought into, like, the more you leverage, the bigger return you get. Although I didn't have a lot of capital when I started. So everything I did was with partnerships, and I was just building. And in order to minimize the amount of capital I would need to go, bring a partner in for, I would get the highest possible leverage loan. And the big lesson for me with that is, although that is technically, mathematically, it is true, you have the highest possible return with the highest amount of leverage, but it also leaves you the smallest amount of wiggle room when things go wrong. And, 2008 was like, I just saw, not just me, but many other people, it was just like a house of cards. And when I looked for a common theme, other than just what was actually happening in the whole economy, but when I looked at the common denominator in everyone that was really struggling during that, it was too much leverage, like too highly leveraged, and you just, not enough capital reserves, too much leverage. And, when your tenants all of a sudden can't pay, and you don't have enough reserves lined up, and you're at the maximum loan, like, there's nowhere to go. Like, you can't maneuver out of it.
Yeah.
So that was, for me, I stopped doing max high leverage, and try to find that sweet spot where it's still a really solid return, but we're not, but there's room. There's room if you need to, like, sell quickly to be able to get out or refinance or something, you can do it. That was probably the biggest one for me.
So what is your loan to value? What's your ideal sweet spot, if you're not going all the way to your max?
It's usually in the 70% range. Now, back then, when I say high, what I'm referring to, because this was before I was doing apartments, it was like 90%. And back then, you could get a 90% loan. You didn't need a job. All you needed was hot breath, a pulse, and fog a mirror, and you could get it. Now, like, if we can get something Honestly, it just depends on the numbers of the deal, because I want as much leverage as we can get, but with enough room. We won't go above 75, but we usually end up between, I don't know, 70 to 72 is probably the most, as far as on the high end, is usually the most that we end up going. I don't think we've done anything 75 in a while.
Now, do you have to like take that narrative to your investors when you're raising capital and kind of explain to them that you don't want to leverage it as much as you could, and the bank would give you more? Or is that something that you just kind of internalize and that's not even a question? They just kind of trust you and
It's too much information for
Yeah.
them, frankly. Because my natural inclination is to educate everyone about every possible minutia thing, because I love to make sure everyone knows everything. I've learned over time that that's not necessarily the best move,
approach.
because it overwhelms them,
Yeah.
confuses them, and ultimately it doesn't help us to raise the capital. So if somebody asks questions, I'll dive in as deep as they want. But stuff like that, I'm like, they don't really need to know. Here's the numbers of the deal.
Mhm.
But yeah, it's not something we do forward facing, because it doesn't help. It doesn't help anything. It just confuses them about what's the
Right.
point of all that.
Yes, maybe we should take a step back and just kind of talk about how you transitioned from, the multifamily and the fix and flips to the apartments, and what that transition looked like. Did you find some coaching, some mentorships, or did you just kind of carve out your own way?
Oh. Well, so it started that I did all of my journey was 12 years in corporate America, climbing the ladder and doing all the things, and multiple 6-figure job, and super comfortable. And it was a side hustle for me. But after a while, I realized that I could actually do this all the time, 100%. And it was around 2015 when I met Stacy, and she was already doing joint venture small apartments and had a course and was teaching people that. And I gotta admit, I was like, I gotta go on more dates with her, because I want to learn that, and I want to figure that out. And so by the time we started talking, and I realized she knew how to do it remotely. So I was stuck in my backyard, not making much profit, having to put a lot of capital out to get very little return, felt really risky. And when she was talking about how she does it remotely and does it in all these different markets, and she builds power teams, like she had me hooked at power teams, and it sounded more scalable, which was something I wanted. And I had also been feeling very alone, because my family thought I was crazy for even doing this. Like, what are you doing? You have your MBA, you've got a great job. Why are you doing this? And when we met and she talked about that, I was a regional where I would get on the corporate jet and fly. I had 12 buildings in the Midwest, and I would fly and help them figure out how to get their performance up. And then I would also have to have a lot of meetings with them from afar before Zoom was even a thing, and really just coach them through how to move the needle on their P&L and all the metrics. So we started talking, and I realized that her remote system and my ability to lead a team from afar, we could put that together. So we decided, you know what, I want to go after apartments, So I think it was RE Mentor I did a commercial training before that, then RE Mentor after that. And, Stacy we were talking about these acquisition fees, and it was really sexy to me. I thought, man, I want to go do that. Let's go do that. So we throw the 40K at Dave Lindahl and go into that program and learn it. But when we went to implement, it was harder than it seemed in the seminar room. It was a little bit more complicated. There wasn't this magic easy button with accredited investors just lining up to give me money. And it was difficult to implement. So then I asked, well, how the hell are you doing it with these joint ventures? Could we do joint venture, but still have the sexy acquisition fee? And that's when we really combined forces with, hey, let's do underwriting differently, and started doing it that way. So we started stair stepping. So we started our apartment journey, not necessarily immediately into syndication. She was already doing joint ventures. I just joined that, but then asked, how can we still get the acquisition fee?
Such a good question.
Changed our underwriting, and then did that, and then just kind of doubled the door count and stair stepped it in until we started doing syndications. Because we had the education for a while, but didn't get into it until later. But that's how we made the transition. She was already doing it. I wanted to do it. I learned from her, but then wanted to figure out those fees. And once we dialed that in, it was like, oh, this is easy peasy. I can stair step into it, and I won't need a sponsor. Eventually I got this.
Yeah. Yeah. That would be a great thing to elaborate on, because I'm sure there's a lot of people that are in your shoes from back then where, they're doing joint ventures and they just don't know how to transition from a joint venture to more of a syndication. So how did you incorporate those fees early on?
So it really came when I was building our own underwriting tool. I like Excel. So I'm an Excel nerd. And I was building out our underwriting tool. just to be able to start like growing when we were going to do, syndications initially. And just part of building it in was because of the syndication model that, I had learned at the time. I was building that into our underwriting tool. And then when we were like, man, this is way harder. Like we can just continue to buy apartment buildings. We don't have to necessarily do huge ones. And when Jen asked the magic question, she's a strategist and a very high level thinker. And I am an absolute in the weeds detail. So I don't sometimes see opportunities that might be right in front of me. But when she asked that question, I was like, well, let me run the numbers of like one of our other deals, like through the underwriting tool that I created and just like, see, well, what does that look like? Would it be different? And it wasn't any different. It wasn't, it's syndication. Obviously you can get into a lot of complexities with waterfall structures and having multiple shares, multiple different share classes. And, but like putting that part aside and just keeping it a little bit more simple, it was really no different. The underwriting was identical on the deal itself, because no matter what, it was still an apartment building, whether it was, a 20 unit or 100 unit, it's the same flow, the same tool. We just built it in. And when I did that, made the realization, I'm like, it's literally the same thing. The deal has to be good enough to build it in, obviously with that. And with, when you're doing smaller deals, you do have to have more room in order to fit that in because the numbers are smaller, but we just started building it into our underwriting and transitioned almost immediately.
And I think we were able to find those deals that made sense and had more room because of the relationships we established with brokers that then would send us off market deals.
Right.
And so it's a little bit better spread there.
So you get the deal off market, you go to your investors or JVs at that point and you say, hey, I've got the deal. And then, so for the fee, you just insert the fee into the operating agreement of the LLC?
That's exactly right. And so like, as an exhibit, as an addendum. So we have the LLC and we're always 100% forthcoming. Cause how awful would it be to be on like the day before closing? And then they're like, wait a second, what is this? And it all falls apart. So that's never anything we mess with. We're just like, here's what it is. It's the same. It's use the same pitch deck as we do for syndication.
Right.
It's a joint venture. It's just the financing structure is different. Instead of everyone being passive, we're all active, and they have some kind of active role. So we just disclose it. Like this is part of it. This is part of the raise. And then it becomes an addendum to the operating agreement. So it's in there. It's with it. It's just in the back, and it's totally spelled out. So it's super obvious. And I don't want it to be buried, because what if they didn't read all of the details and they realize a year in and they're mad? We don't mess with that. Just be forthcoming. It takes a lot of work to take a deal across the closing table, which every investor knows that. And if we ever have a partner who's like, well, what is that for? And when I go through the sheer amount of work it takes us to take a deal from concept to closing and how much work goes into it, they're like, okay, yeah, that's fair.
So you're doing, in that case, you're just doing acquisition fee. Were you also doing an asset management fee as well?
It depends on the deal. Depends on how, I think it's funny because, and I know when we were talking with our syndication attorney recently, and she was like, well, I could see how you could do an acquisition and disposition fee. I'm not sure about an asset management fee because technically everybody's active, but my argument is they might be active, but might not be active in managing the asset. That's that's our job. They might be active in taking the minutes or dealing with the CPA at the end of the year, some other role. So it depends. Sometimes we do, like in the most recent deal we did, that was a joint venture because we closed a joint venture and a syndication within 2 weeks of each other. But in the joint venture, we had an acquisition fee, disposition fee, and asset management fee, and a bigger carve out because the deal was just was that good. It allowed us to have all that and have our JV partner still make very, very high returns. Anyway, so every deal we just see like, what can we squeeze out of it? And if we can do that and get more, compensated better, but still make sure our partner's taken care of and they're good with the numbers, then cool. That's a win-win.
So the carve out would kind of be like a waterfall at the end, but you just put that in the operating agreement?
No, it's like when maybe terminology wise, I'm not using the right term, but what I mean by carve out is, how like in a GP, like the GP owns 30% of the deal or 20% of the deal or whatever. That's what I mean by that. So there's no GP in a joint venture, but we would use the terminology operator. So we'd have the operator carve out, and that particular deal we were able to do 40%. And that was unheard of. We've never done a deal where we could pull out 40% of the ownership and still have the numbers be so good for our partner. But It was just,
Are
it was
you
a really good
are you
deal.
also investing in that as a limited partner too?
Well,
Or
in
are
a
you
joint,
putting your funds in the joint venture? Yeah. Okay, go ahead.
yeah, it depends. In that particular one,
Yeah.
we didn't
Did
need
not.
to.
Yeah.
Okay.
But generally speaking, it just depends. We're usually putting something in, and sometimes it's the how long the relationship has been going. Like these partners we've known for, I don't know, 8 years, a really long time. So there's a high level of trust. If someone was like a new partner and they were like, I'm not really sure,
Yeah.
we might need to do that just if they have comfort that we have skin in the game.
Yeah.
Ideally, we're not putting in capital because we are doing the majority of everything
work.
else.
Yeah.
And we like to be able to put our capital into the LP side of the syndications that we're GPing on.
Yeah.
Yeah.
But it just depends. Some of them we've put money in, and some of them we haven't. We haven't needed to because the partner was okay with it. We
Well, I
have,
mean,
we have a good enough reputation because of the number of years and the way
Yeah.
we've operated that there's a high level of trust.
There's also an element of sometimes instead of putting capital in, we like to keep it in reserves
That too.
so that we have that available.
Thanks 2008.
Exactly, because of what we
Yeah.
went through in 2008 individually.
Yeah.
But a collective strategy being that we should have reserves, and
Yeah.
if I need those reserves for that deal, it's my responsibility to bring that in because I don't want to do a capital call.
No. Yeah.
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 Well, that sounds like an incredible deal to carve out 40% and still everybody's happy. So
Yeah.
what
We were
year
a little
was that?
shocked. We were a little shocked when I was like, we can legit do 40% and acquisition and disposition. Like,
Yeah, it was a good deal.
whoa.
Seller finance
It's just,
too.
and it was seller finance
wow.
at 5% for 70. Like it was just,
Yeah.
it was a dream deal.
Perfect.
It was small. It was a small deal. It was only 13 units, but it had 20 storage units, which I think is
Okay.
part of what it created a massive amount of cash flow.
Absolutely.
Yeah.
And it allowed us to carve it out more. And
Mhm.
our partner, our partner doesn't care. Like, what are we making? They want to know, like, what are they making? And as long
Right.
as what they're making, they're good with, they're like, they don't seem
That's fine.
to care what,
Yeah,
if we're making
it's a
too much.
win-win.
They don't have that mentality.
Right. And then as far as the power team, because I'm sure you needed a power team wherever that was, right? You're both not
Everywhere.
living in that market. So how are you forming your power teams to make sure that, your underwriting that you're doing remotely is going to work out the way that you plan?
So anytime we're making a move into any new market, we're identifying, obviously brokers, property management, contractors, if we're rehabbing, building inspector, et cetera. So we have a team, but our team usually has a 3 deep bench strength. So when we are, in particular, like when we're vetting the market rents, like we're looking like what is possible, what's the upside, we will talk to all of the property management companies that we are considering, and go pretty deep on that research, because that's one of the things that has the biggest impact. But like we're in contact with the county about the property taxes and like what is it going to be? What is it going to be next year once this is recorded? What's it going to be 3 years from now? How often do you reassess? Although I guess that's not about power team.
Well, strategically also is because you already said when we have the brokers, we have inspectors, we have contractors, we have people that we will go into the market and interview and vet them in terms of that. Once we're in a market and we've established that it's a good market, the job growth, the population, everything is steady, there's upside, all of those things. Once we get into one deal and we see that it's working, it's like we test the market with one deal, then we'll do a couple of more using the same team. And then the market that we're talking about right now, we have just been deep in since 2017, trying as hard as we can to slowly take it over all over the whole state, So it's like, once we have a team there and the market's good and we're seeing the returns, we'll go deeper in that market, because then we have more leverage and we can leverage the same team before we go open up a new market. It is a heavy lift to go open up a new market. But once we get a good market with a good team, we'll go as deep as we can there until we've sort of exhausted the opportunities. And I'll tell you, in Indiana, we haven't exhausted it yet.
We like
Indiana.
Indiana.
We like Indiana. Yeah, we like Indiana.
I think that's our favorite state.
It is our favorite state
as far as the markets.
How are you identifying your markets?
We actually do a whole class on it. So, because there's the market. It depends on if you want a stabilized market or if you want, an emerging market it's on the verge of gentrification. And that's when we first got into Indiana. That's what it was.
Yeah.
It was like on the verge in most of these places. So we've literally realized a lot of equity in that market because we got in there as it was gentrifying and stayed
right.
ahead of it. So there's that strategy that we use, but we also like to go into a market where we just want to cash flow on day one, if that's the type of asset that we're trying to get into a stabilized. And we like to we treat our portfolio sort of like a stock portfolio. We like to have different asset classes, whether it be multifamily or single family homes, small residential. Eventually, now we have self-storage and the mobile home parks, RV parks. Everything has a mix, but also a mix of when we're going to go in and do a value add versus when we're going to go into a stabilized. And with the economy and what it's doing right now, we used to do like a 3-to-1, 3 value adds to 1 stabilized. And now we're doing like 3 stabilized and almost 0 value adds. The value add being a little bit more of a hybrid where we see the upside and we can do it just through increasing NOI and market rents and those types of adjustments. So when we do these things and we go in there, it's like, it's a whole different strategy to approach it and not think about just one strategy. So when we're going into that market, we already know what we're trying to accomplish and what type of property we're trying to get, because that's what we're trying to fulfill. Or if one comes across our table, if we have the bandwidth to do it, we figure out how to strategically take that one down too. I don't know. It's not just a one strategy approach.
Well, remember when so one of the things that we did a couple of years ago, which Jen had the idea, she was like, because she's always up here thinking like high level, when we're trying to figure out like, well, what movie do you want to make next? Why don't we see like, well, where is everybody going? Like post COVID, where's everyone going? Because people are moving, once things opened up a little bit. And so she started doing research and looking at migration patterns through like the United Moving Land. What was the other one?
United Van Lines, not necessarily U-Haul. Was it Allied?
Not U-Haul, but I can't remember. It was like Allied, but it was basically 2 of like the larger national moving companies, and just looking at, because they do detailed reports for their own marketing purposes. And we were like, So we would do that. We would look at like, well, what were the states that had the most inbound migration, if that's the right word for it. And then we would go identify all the MSAs, and we would look at, okay, well, what's going on? Like, what are some of the larger MSAs and what's going on there in terms of population growth and job growth? And so we would just start like honing in, and then we would just, make some calls and see what would come up.
But if you go to USNBC, there's like a list of the top 10 states where you want to do business in. And that's another tool that I would use to go in and find out, well, which ones are the best in business because they have the lowest tax. They might be landlord friendly, and just research heavily in there. Another thing that I like to do is I like to ask the question of like what new laws are coming out or what legislation is happening. And something that fascinated me back in 2021 was they said that they were going to do only electric cars as of 2030. So researching and going deep into that, I'm like, I don't know that that's going to happen, but just in case it does, where are all the auto manufacturing plants at in the country and what's going on in those markets? So we went deep in there, and we really identified in Tennessee a little triad pocket, like Chattanooga, Nashville, just going into that area and finding out where are those little pockets where there might be a lot of another Indiana is what I was trying to find. Yeah. And a lot of our students sort of followed suit and just went into those markets recently, and they're starting to see it happen. So nice. I like the top 10 on the NBC, the top 10 business states. I like to follow that and see what's tracking, and just really find a good pocket. But that's like when things are you can be a little bit risky. Well, if I have a high risk tolerance, but in the beginning, not so much. In the beginning, I was just like, oh my God, it took me 7 months to get $1,500. I've been doing this for 12 years, just getting something that'll pay me on day one, and then doing that for a few years before diving into a little bit more of an advanced strategy and taking a little bit more of a risk, especially when you have to have investors that trust in you, that you're doing the right thing. To get in there, which is one property, test it, see how it goes, then go deeper, see where that goes, and find out where that path of progress is as you're doing this. It's a little bit more advanced, but oh my God, it's very lucrative. It's very lucrative.
That was a fun big research project, because we did one enormous one. We were trying to decide like where we're going to go next. And it's one of the things that came out of it that was interesting that we didn't make a move on, and I'll explain why in a second, of all the different MSAs that we had narrowed down. And there was maybe 25 that we were like, okay, as we're narrowing, like so many of them were in Florida, which is where we now live. And I was like, interesting. I've always invested remotely. I've never invested where I live. So the thought of investing where I live is like, wait, so does that mean I'm going to have to go drive there and traffic? But anyway, but so many of the up and coming from a data standpoint, from our data standpoint, I was like, man, Florida is that's just where it's at. But the reality is it's not where we're choosing to invest because the insurance costs are so high that migration or not, like the deals are very difficult to pencil. And you know, we had a couple of hurricanes in 2022, we had 2 hurricanes. And I was like, you know, and some of the people that we know that own property here, it was hard on them. It was hard on them. So we don't follow just based on the data. You've got to have to look at all of it too, but that's how we also narrowed it down.
I think this year it's all about that floating rate and the impact on a lot of owners out there right now that are just squeezed. And that there's 2,500 properties facing they're facing foreclosure on the multifamily space. And you think when we look at it, it's in Texas, it's in Florida, and it's in Phoenix, like in the Arizona market. So for me, that's my next thing. Like that's my next breadcrumb trail that I'm looking at is how can we find those distressed sellers? Because it's not like the market is bad. It's the financing was bad. And now they're in a pickle. But how can we, you know, help them while helping ourselves at the same time? So those are areas that I'm now fixated on. 2020 and 2021, I was more fixated on migration and where can I pick that up? And now it's like, if I can find some pockets in the Phoenix area, in Texas area that they're distressed, but the market is still good. That's where my sights are personally. So that's just how I pick markets.
Do you think they'll make it to foreclosure? Or do you think they'll be worked out with people like you that are kind of waiting with cash and just want to gobble this stuff up? Or you think some stuff will actually go to foreclosure?
I hope to God that it's from people like me, because that's a win-win versus going to foreclosure. So that's why I'm fixated on it. That's suffering. Like I can't even imagine how they're
that sounds so stressful.
You know, it's very stressful. Especially
we remember what that's like.
It brings me 2008 vibes, which is, you know, at that moment in time in 2008 was like, stressful. I'm not doing floating rate debt ever. Like, so to me, I don't know. I mean, I hope that it is based on someone coming in with cash and figuring it out and helping versus them actually going through foreclosure. Cause I wouldn't wish that on anybody.
I think people are going to have one of the things, even with the floating rate debt, it wasn't like it was 85 or 90% loan to value. So I think that for the operators who are in that situation, that can sell and at least at a break even, or their investors are probably going to lose some, hopefully not all, but some of their capital that they put in. Well, I think that they will be able to, if they do it soon enough, I think that people have the opportunity to avoid foreclosure if they move quickly enough and are willing to let go of the property without the profit that they originally put in, because that's no matter what, that's not happening at this point. So I don't know. It'll be interesting to see. I mean, there's 30 to 35% equity normally in them, so there's some room.
Do you think there's operators that are just praying for the rates to come down to make things better again, and they're going to be the ones caught?
Probably. I just, you know, and it's quite honestly, the first rate hike happened in March of 22, and it takes 27 months before we see what's going to happen with that. And June is the 27th month. So I don't anticipate that they'll drop it before then, but I guarantee you there's at least, you know, 2,500 properties out there where people are like, bring it down. Let's see what happens. But there's a tail end effect of how fast that comes down and what that looks like. So, and depending on how long they've been in the red, it might not help. So that's why I hope that people, and who knew? Nobody knew that they were going to raise the interest rates this aggressively. I mean, I know this is an election year, but my God, that was very quick. They waited too long to start adjusting things. And now that's like the fastest we've seen in at least 40 years in terms of a rate hike. Aggressive, just very aggressive. So I feel for those operators because I guarantee you if they bought a rate lock that's at 6.5, man, and they thought they were solid because they came in at 3.5, who's ever going to imagine that it's going to get north of 6.5 in that short time? So I feel for them. I do. And I hope that it doesn't come to foreclosure.
Are you guys going to start attending a lot of these events where there will be operators to see if you can find operators in distress? Is that part of your game plan moving forward?
We're in a network where there are some,
Yeah.
and yeah, and I also we have a capital company, right? We raise capital, and we have some of our investors in our capital company that are, hey, I have a lot of cash and it's liquid, and what's going on? What's the strategy? As we interact with these operators that are either in distress or, they're just ready to off it, whatever that might look like. And from a negotiation standpoint, we're poised and ready to take care of that and take it down. And we have about 150 active investing students in our academy that are for the same. We don't have anybody in our academy that's facing this, because we told them back then in 2020, do not take floating rate. Don't do it. It's going to, what goes down comes back up. Don't do it. So none of them did. And so now we've got all of our students in our academy that none of them are facing this, and they're ready. They're like,
awesome.
Oh, you told us this was coming and now it's finally here. We're ready.
Yeah.
And then we've got the investors to come in too. So we're definitely feeling very strong and certain about how we're positioned for this. It's unfortunate for the others, but if there's a way that we can relieve people of that because we have the means to put it together, then it's a win-win.
Yeah. And we've been on the other side of it. Like we know what it's like to have that stress, and it's awful, but
it sucks.
It's almost like it happened for us to be able to appreciate what it's like to be in that
today,
in that situation. And we really thought the interest rates were going to go up way sooner, which is part of why we were telling our students, like, don't do it. We had stopped because we do all sorts of strategies, including fix and flips. But in 2018, we wrapped up the rest of the properties we were flipping, because we were like, it's got to be coming anytime now. It's just been good for too long. Yeah. And I really believe that because of COVID and, to prop up the economy as quick as possible, print money and do all the things they did, I think it would have happened. I think what we're going through right now would have happened years ago if COVID hadn't happened. And I think it delayed things. And now, but that was really why we were telling all of our students, like, don't do floating rate debt right now. It's been good for too long. Yeah. It's gonna switch. And I kept being like, any day now. And then finally in 2022 it started. But yeah, I was not expecting it to be that bad. So I'm really glad we were telling them not to do it, because that would have been not a great feeling.
Are you guys doing blind funds to prepare for this, since you might not know what's in distress or how you're going to acquire it, whether it be a legitimate foreclosure or not?
No. And really a big reason, the first time I had heard of a blind fund, and I was like, wait, what are you asking us to invest in? And he's like, we're going to go for different types of properties within this thing. And I'm like, if I'm going to invest in something, I have to be able to vet it. Like that's me personally. 2008 trauma. Yeah. Exactly. I need to be able to vet the property, the operator, the financing, all of it. And I think because I think that way, it might be a limiting belief, but I have a belief that I would never be able to sell that, because I'm like, how could you just put your money with us when you haven't even looked at what the asset is? Yeah. And so we haven't done that. And I don't know that we really will.
I don't think either of us would be able to sell it, honestly.
Yeah, because I just believe
as the GP though, if you're the GP and you're the one acquiring the assets, I'm working on a blind fund now, setting it up, and I've done foreclosure investing for a number of years, the last decade or so, and I've had a lot of investors that have seen me do this along the way, and they say, hey, I want to get involved. There really wasn't any avenue other than for me to create a blind fund to have them participate, unless I just basically held their hand and there would be no compensation for me for doing that. So that's the reason why I am pursuing this avenue. But yeah, everybody that I've talked to is like, yeah, blind funds are difficult because the people have to trust you completely with their money and know that you're going to do the right thing with it.
Right. Yeah. And we see, I can definitely, that's why I'm like, I recognize that it's probably just a limiting belief on my side because of how I am, but our investors aren't like us. Like they're not like analyzing everything to an gnat's butt, right?
We were literally just having this conversation yesterday. That's why I'm kind of grinning over here.
Yeah.
Going and vacillating on the fence about fund, no fund. What do we, and so this is interesting timing.
Yeah. Yeah. But to your point, even our investors who are investing in like the specific deal, even though I'm like, of course they need to be educated about the deal. They're not making the decision because of the deal. They're making it because they're like, oh, well, Jen and Stacy say it's good and they're investing in it, so I should do it. So it's a fair point. I don't know. Who knows? Yeah. Who knows? In the future we might grow into that.
I just feel like with the foreclosures on the horizon that it's, for me, I think it's a good time for me to get it all sorted out and be able to, if there are those opportunities where some of them, I think there's going to be so many that they're not all going to get worked out. There are going to be foreclosures.
They are.
And so that's kind of why I want to position myself like that.
Yeah. I think that's really smart. I think it's really smart.
Absolutely.
I'm like,
I'll tell you
I
what,
might need some mindset work.
I think we just worked through a limiting belief, didn't we? I think,
Nice.
you know, if as we're meeting with folks, if it looks like there's no way we can save them and it's going towards a foreclosure, we'll definitely reach out to you.
Yeah.
Because we don't have a blind fund, you know,
No.
so it's like we can win-win and pass that on.
Yeah.
And maybe at some
Perfect.
point we can hop on the phone and talk about blind funds so that, you know, Stacy can try and get over her trauma.
Yeah, absolutely.
Maybe, I don't know.
So how many markets are you guys experts at? It sounds like you're in a lot of different geographies.
I mean, from an
Expert
expert
then?
standpoint, I don't know, probably about five.
I
that
only
we're-
at 4 because
Yeah.
Yeah, we have 2 markets in Texas. We have Indiana, we have
separate ones. Yeah.
Kentucky, and Ohio.
Yeah.
So
That's awesome.
Yeah.
yeah,
As
I mean,
far as-
Texas is probably our least, just because we are not the GPs in
I
those.
feel
So
like I'm an
Okay.
expert in Phoenix, though.
yeah, you are an expert in Phoenix.
I've lived
so
there twice.
I believe we'll be
Dissecting
acquiring
the
things
crap
there.
out of it right now. We will be acquiring there. So yeah, but I love that question because it is, you got to be an expert in it. Even if you don't live there, there's ways to do that. And I definitely have my eyes on Phoenix.
Yeah.
I like it.
Then here's a random question. I'm always curious about, as far as payroll goes, do you guys keep it simple and just subcontract anything that you need? Or have you found that it's beneficial to bring people on W-2 payroll under your organization to help push the needle forward?
We don't have any
No.
W-2 employees. We are
'Cause we
all
have had them
1099.
in the past.
Yeah. So
Not a fit.
yeah, we just do all the 1099s that we possibly can and subcontract stuff out.
Yeah. And you know what you're getting, and you can kind of cancel it if you don't like what you're getting, et cetera.
Exactly.
Yeah.
Exactly.
I've gone the opposite route. I've got a pretty extensive payroll, but I totally get, that's why I asked the question. Cause a lot of times I wonder, like, should I have payroll or should I just contract people?
Yeah,
But,
it really it came from
Yeah.
having had this is a really long time ago, but when I had a property management company, and I had, you know, everybody was on payroll, and at the time I was like, I don't know that I want to do this. I don't know that I want to do this again.
Right.
With having actual employees, and even when I worked in corporate America and having employees and stuff, and I just think it's just been a better fit for
Mhm.
us personally. I don't know that there's one that's right or wrong. I just was like, you know, I don't like this. I don't like having employees and having to do all the payroll reporting and this, but
I like it for the delegation fact, you know, so as a contractor, they're going to stay in their lane, and, you know, I have a contractor for marketing, I have a contractor for this and that or whatever. But if I have somebody on payroll, I can just kind of dump stuff on them and say, I need you to do this now.
Yeah.
And it kind of, so for administrative stuff, I love it, but I totally get what you're saying as far as keeping the W-2 as low as possible.
Yeah.
Yes.
I mean, we have a handful of people because of our academy. We have a handful of people, and they're still not W-2 employees, but they operate so similarly that it's the same thing. Like, hey, I just need this. We don't think anything of it. They're not usually running like multiple businesses, but they have all the autonomy for like when they work and things like that. But it's the same benefit that we get from having like that kind of employee, but without the employee side of it. And
we set the metric on what we need, you know, so they have their report card on what we're trying to measure. We agree to that. And so, you know, we'll do the contract in a 12-month increment. But it's also like within 30 days, if either party decides that this isn't a fit, we can part ways.
Yeah.
So I never feel like I can't delegate things to them. Like when we do a weekly meeting and we're talking about things, it's like, hey, these are the metrics that we're trying to drive. And this feels like these are the tasks. When do you think you can get that done by? Cool. I actually need it this day. Can we do that? Can we focus on that? And it's, I think, a culture that they just start to adopt into. Okay. And I think while we're vetting them, we're feeling out how would that process work for you? Just very transparent. What does that look like for you? And they're like, yeah. So we've just kind of dialed that in a little bit for ourselves. And I don't see that a W-2 structure in our future.
I think too, one of the things that might be a little bit unique for us, just based on people's responses, is because people are built into our vision. Because it's not just, it's never just about real estate for us. Like we have, you know, obviously we care so much about the people that we're raising up, and our our staff, they know that. And they're so into like the vision and our vision for being able to literally change the world, even though we're using the avenue of real estate investing and educating and providing good housing for people. But really our mission is let's change the world. This is just the avenue we're using. And then, Jen does so much mindset stuff. Part of it, I think that all the people that work with us, it's like they have this strong desire to be part of something.
You're part of a movement.
And so I don't know that. So I think it's maybe a little bit different than what we would be experiencing if it was just a normal contractor or even employee situation, because they want to be a part of it.
That
and
makes sense. Yeah.
Anyway,
I thought of it that way, but yeah, it makes sense.
Yeah, they feel like it's more than just the task for them, or more than just the real estate.
They're
and they
tied
see
into the vision.
they are tied into the vision.
Like an employee would be.
Right. Yeah.
Yeah.
I guess so.
I mean, some employees. Not all.
Right.
It's got to be good for lead sourcing as well. If you've got this big academy of people that, they love you guys, you're teaching them, you're lifting them up. When they find a deal, I'm sure they're going to bring it to you. That's got to be beneficial.
We actually have that's why I wanted to start the academy selfishly, was I wanted to clone us. So we actually have a process. And when people come in that first year, we're watching them and we're making sure they follow in the system. Are they taking shortcuts? Or if they have a blip or a hurdle, how do they respond emotionally? How do they respond? Like, are they resilient? How do they handle challenges and communication? And at the end of that first year, if we like what we see, we make them an offer to stay in the academy for years 2 and 3 and go to the next level of syndication, 506B, 506C. And then we'll do deals with them because we've watched them for a year. And then they have a seat at our table after year 3. Like, they never pay tuition again. They're just with us. And we did the 98 unit with the
96.
team. Oh, the 96
48.
unit, 48 unit, and the 13 unit.
13 unit with the 20 storage.
And then a quad.
Yeah, we did a quad.
We've done 4 deals with students in the last 2 years that, they're rock star students.
Yeah,
and they know our system really well. And because they've earned that trust in us, but not necessarily trust, but we respect that they've proven that they do our process. So we're more inclined to bring those types of deals and do that with them when they're following that system. And it's like, we have our own acquisitions team because of it. We've trained them in a way, we've cloned ourselves. And so we don't really have to look for deals anymore. They come to us now, and it's awesome. It's awesome.
So your acquisition team, that they are your students, right?
Not anymore.
Graduated students.
More like a peer, but yes, they were once students, and now
they were once students.
And
now
they're
they're just
circle.
Yeah, they're in the inner circle.
So we don't have to
I love
pay
that
them.
model.
They're part of the deal,
They're part of the GP.
So they get paid as GP versus us having to find a VA to go find deals and stuff. So it's a system that when we were crafting that back in 2019, I was like, oh my God, I see the potential here. If we can own ourselves, we're going to have a lifetime of pipeline coming in, and it'll be epic, and then we can just focus on capital raising, which is what happened. That's literally what's happened. And it's awesome.
Yeah. Are you guys parts of other masterminds currently, or you're just running your academy?
No, we are in, we're in Raise Masters. We're in the Capital Collective with Hunter Thompson we raise capital for our capital company. And then we're connected with the Platinum Partnership with Tony Robbins. And we have a lot of friends there. We joined that ultimately because those folks are just playing at a different level, thinking at a different level. And just when you're in proximity to people like that. So we're constantly investing in ourselves and trying to learn and grow and continue the journey. So that way we can bring our students along.
Yeah. We are always in something that we feel is going to like stretch us, help us elevate or make us want to elevate our level. Totally. We're always we have never not been in something, or when something's wrapping up, we're like, is this good for another year? Or do we need to level up again? And
exactly.
Yeah. So I'll see you in Phoenix next week at Race Fest, maybe.
Yeah. Jen's actually speaking.
I speak on day 3.
Yay. Yeah. That's awesome.
I'm excited about it.
Very cool.
Yeah. So we will. Yeah. We'll see you.
Definitely.
Yeah.
Cool.
Very cool. Yeah. This is awesome, you guys. Thank you so much for coming on the show. I mean, we still have a little bit of time. If there's anything that you guys are passionate about that you want to dive into, we love talking about what makes you get up and do your job the way you do it.
I feel like you should talk a little bit about, well, who are your listeners from a standpoint of, who is your audience? Because I feel like you could probably share some things that will help people once we know who the audience is.
I think they're people that, want to get to where you are now, that are you know, they've got some experience in real estate. Maybe they only own a few properties. Maybe they're, you know, maybe they got in late and they're doing some Airbnb type stuff, but they're
Okay.
all people that are passionate about real estate that want to take their, wherever they're at, they want to take it to the next level. And
Okay.
that's kind of why we started the show. You know, Matt and I, Matt's in Denver, obviously, but we're from Rochester, and we grinded it out like you guys did. You know, we started with a single family home. When you were telling your story at the beginning, I was like, been there. You know, I'm scraping the popcorn off the ceiling. I got
Right.
tape all over the walls. I look at pictures. I'm like, what was I doing? I had no idea what I was doing.
Right.
So, you know, we've been grinding it out for so long. Our mission is to help people avoid a lot of the mistakes that we made and ultimately get into whatever's best fit for them, whether it's an
Yeah.
LP, a GP, or, you know, if they want to continue to rip their hair out as a landlord, you know, we'll still help them.
Yeah, I love that. So I think that in the beginning of anything, it all starts in our mind, right? So I'm a mindset coach. I like to get people into peak performance and make sure that they're staying steady to their goal. That I would just want to share, like, there's 5 major obstacles that people face when they're going to quit, you know, and the very first domino that knocks over the other 4 is the wrong motivation. So when you're not connected to why you want to do it at a deep, deep level, and I'm not like, because there's extrinsic motivation, the thing you're striving for, but there's intrinsic motivation. And that's the piece that I want to talk about a little bit. And that's like, why do you want to do it?
Yeah.
And being able to ask those questions, because when you get into the journey and you're making that jump from being Airbnb to multifamily, or you're jumping from single family homes to multifamily, it's a different way of thinking. It doesn't have to be so huge that it overwhelms you. It's just a different way of looking at things. And if you ask yourself, why do I want to do that? And find out, you're going to probably list the first 5 things are going to be extrinsic, what I want to have. You know, when you think about what I'm going to receive from that, that's awesome. But what really motivates us and gives us leverage over ourselves is when we ask that question and we're searching for, well, what will my loved ones get as a result of me doing this? How will their life change? It's crazy, because as human beings, we're wired for survival, but we're also have these strong instincts to protect the people that we love and to make sure that they are, you know, constantly having a good experience or a good life. So sometimes we need to do what's right for us. And I like to ask the question of, what are my loved ones going to get as a result of me going for this? And then what awesome feelings am I going to have about myself if I actually go for this and when I achieve it? And I think the third best question to ask is, what must I do that I don't want to do when it comes to this jump and making this leap? It'll surface all your baggage, like all your crap that you know, when you were a kid and you were wired and your money relationship is off, or you have a sense of, I'm not worthy of this, or I don't deserve this, or I might fail at this, or even worse, being a perfectionist and striving for perfection. And I don't want to make a mistake. And my biggest fear is failure. The truth is, like, if we just got to redefine failure, it's not really failure, it's a lesson. And if you can apply the lesson, then that mistake actually becomes wisdom. And when we reassign meanings and make them more positive for ourselves, we empower ourselves to just say, you know what, I am going for it. And this is why I'm doing it. This is what my family's going to get. My loved ones are going to get. This is what I'm going to get. This is how I'm going to feel. And this is who I'm going to become because I'm doing this. And when we stay fixated on that, no matter what obstacle or hurdle comes up in our way, we're going to persevere. And our resiliency is just going to be so present, and we're so certain in it that anything's achievable. So get that first domino and really identify why you want to do it. Why do you want to make that leap? And then identify the what must I do that I don't want to do, because that's your glass ceiling that's keeping you here. You know, break the glass ceiling, and then identify what that thing is and do the thing. Because as soon as you do the thing, it's like, oh, everything I wanted was on the other side of this. And it was painful, but it was short-term pain versus the long-term pain of never knowing if you would have been able to do it, and never knowing what lessons you were going to learn or who you're going to become along the way. That's my favorite thing to try and address for folks that are wanting to do something, but not taking the action, or maybe a little bit hesitant. Just believe in yourself, because you can do this. Once you identify and get leverage on you, it'll give you that intrinsic motivation to do it.
Yeah.
Hopefully that was helpful.
Oh yeah. One of my students, he's not a student. I mentor people. Like, if I see they've got promise, that's kind of how I pay it forward. Cause I was probably a pain in a lot of people's sides by just calling them and saying, hey, we're friends, right? Can I ask you a bunch of questions? if I find somebody that's like eager and hungry and they're really determined to like succeed, I take them under my wing. And the fellow that I'm helping right now, one of his constant refrains is he's like, "Why are you doing all this for me?" And I'm like, I think the problem is that he hasn't found his why. He did, and I try to tell him, I'm doing this because I like helping people. I like seeing people succeed. That's part of why I get up in the morning, because I want you to be successful. And I think he needs to find his why in order to really take it to the next level. And so, he's got all of the things he needs to be successful, except he doesn't know what his why is.
Mm-hmm.
So any advice on how somebody might get past that and figure out what their why is, instead of just really, like laser focused on like the numbers and the dollar signs and paying the bills and, all that?
Totally. I think that finding your why means that you have to ask it 5 times to get to the source. So it's like, okay, what's your extrinsic goal? What do you want? Oh, I want to get into multifamily. Okay. Why do you want to get in multifamily? And asking that, getting that answer. And then whatever that answer is, okay, but why do I want that then? And asking it at a 5 layers deep, all the way down to really expose the real reason.
Can you give an example?
Like
I want to I'll start it.
Go ahead.
Because I think that it's more tangible when you're like, oh, okay. Because it really is a very good exercise.
Go ahead.
So like if someone says, I want to get into multifamily, well, why? Well, because I want to make passive cash flow.
Yeah.
So that's the worst one. Then why? No, you can.
No, you go. Why?
Why
do you want to make passive cash flow? No, but why do you want to make passive
Because I want to have options. I want to have choices about how I spend my time. I don't want to have to go to a job. I don't want to have to work for someone else.
Why don't you want to have to work for somebody else or spend your time the way someone else tells you to?
Because I don't like for people to tell me what to do.
Okay.
That might not be the real reason. No,
that's totally the reason, right? It's totally the reason. Okay. So now here is a question. If I ask her, why don't you like people to tell you what to do? This is where it gets really raw. So why don't you like people?
Oh my God. I wasn't expecting you to do that. I wanted you to come up with an example. Dang it, woman.
Yeah. Why don't you like
this.
people to tell you what to do?
Because I want to be in charge of my own destiny.
Okay. Yeah. Why do you want to be in charge of your own destiny? First thing that comes to mind. Why do you want to be in charge of your own destiny?
Because I want to make sure that no matter what, that me and mine are taken care of. I just don't ever want it to be in someone else's hands.
So now you get all the way down to that. Now we're going to flip side it, because that's we're getting down to the root. Now we're going to flip it. What happens if you and yours aren't taken care of?
We starve and die.
We starve and die.
I know it seems dramatic, but I think that's the underlying root of it.
I love it.
We have no home, we have no food, and then we waste away and we die.
But there it is. There it is. That is the internal drive. If you truly have, by the way, that's a limiting belief that we'll have. That's a whole other episode.
I know it's ridiculous. It's ridiculous, but
that was so raw and authentic. But it also is it's her why. So if she has a true belief that she's going to starve and die, and so is her family, if she doesn't get passive income on her terms, doing what she wants and nobody else telling her, that's going to keep her motivated. So when a floating rate debt deal is bad, she's going to figure out, come hell or high water, because she thinks her kids are going to die. Tell me that's not motivating. She's going to do it. And I'm being dead serious.
I know, this is funny.
But that is what is going to keep her going. And because she now knows it, and now she's associated to it, and now more importantly, we're really going to take off now. I really just associated that why to getting more passive income. And now that she's aware of it, whenever that hurdle comes up, her unconscious mind is going to say, no, remember, we have to do this, because if we don't, your kids are going to die and you're going to phase out. Like, you got to go. And that will light the fire inside. But that was actually fun. I'm glad we did that.
Yeah. Because I'm gonna do that to him later today.
Do it.
Yeah. It really is good. I've seen Jen. It's funny. I've never had her do it to me before, but I've seen her do it with many people. And it really does. I think part of it, because when I started investing, I didn't need to go 5 layers deep. I didn't know the real reason. I was so enthusiastic about the possibility of creating wealth and income, and I grew up with not having a lot of money, and money was a struggle. And I was like, that's never going to be me. I'm never letting that happen. So I was very excited about the possibility of creating passive income, which is why I didn't quit, even though God knows I probably wanted to several times, but I wanted to make it happen.
Yeah.
But I never went through that exercise.
Well, I'm really glad you challenged me and said, do an example, because I couldn't think of an example. I'm like, oh my God, we're live on a clock.
Right.
So the fact that she just did that and was vulnerable enough to do it was pretty cool, because that was very raw and authentic. And when you can do that with yourself or help others do that, it gets you associated to that intrinsic motivation on why you want the external thing that it's like the carrot or the stick. The carrot's what you're chasing. The stick is the thing inside of you that's going to go, hey, you said you're going to do this. And if you don't, you're going to have your kids die.
Right.
You know, so like you got to figure out the carrot and why, and the stick to get you back on course. That was really cool. That was a really good example. So I hope it works with your friend that you're teaching and spending time with.
Yeah. And then how would you address overcoming obstacles? Because I think that's probably what he's going to lead the conversation into, because, you know, he's going through some turmoil, and that's probably gonna, how do you get somebody to overcome that kind of stuff? Say you did something stupid, maybe it's a really bad deal, you're going to lose a lot of money, you feel like, you know, your career might be over, or people are going to look at you differently or whatever.
Oh man, I have an entire mindset course on that, and I'll give you the link if you want to share it with the audience. But one of the things that I teach in there is your resilience factor, being able to take some problem or challenge that's happened, and it's really got you ruminating and you're spinning in your head about all the ways that you messed up or someone else messed up. No matter what the circumstances are, now where do I go from here? If you're ruminating on what's happened in the past, there's 3 things that cause suffering. And it's when you're too focused on and worried on the future and what's going to happen, or ruminating on the past and what you wish you would have done differently, or when you're too focused on yourself. All 3 of those, future, past, self, all 3 with a hyper focus cause suffering. So anytime that's happening, force them to change their physiology, like stand up, shake it out, get your nervous system going, and start walking in one direction. And as you're walking in that one direction, just shaking it off and moving your body and thinking about, what am I grateful for? Like, what's going well? What evidence is there actually that life is not that bad? And in what ways have I in the past shown up and overcome other obstacles, other hurdles? In what ways have I already won in this particular type of incident in the past, so that I can remind myself of who I am while I'm walking and moving? Then I like to stop as soon as I'm like calm and I'm not freaking out or afraid or angry, because this works for any emotion. Then I'll turn around and walk back to where I came from. And as I'm doing that, I'm trying to feel 3 things that I'm grateful for in that moment, that I'm going in so deep that I'm actually going back to my body, what I saw, what I heard, what I felt, what I smelt, even if I tasted something, like what was in that moment, until I'm smiling. And I'll do that for 3 different examples. And I have some that are like really good ones, like my wedding day, the birth of my children, the time that I went through and I broke my first board at my NLP training. There's all these memories that just remind me of, man, I'm really grateful that I took that path, or I'm really grateful that these kids were born, or I'm really grateful that I found the love of my life. I'm really grateful. And you just start smiling and you're turning it around. And then the 3rd piece is find somebody that you can help, because when you're helping somebody else, it's impossible to feel helpless. So if you find someone to serve and help, you're going to start showing yourself that, you know what, I actually do have my crap together, and I actually am a valuable human being. I have skills. I've overcome things in the past, and I have the ability to help other people. You're starting to get in touch with who you are again, because this one thing that's happened, it's like so right here in your face. You know, you got to kind of close your eyes, make that small, and imagine yourself growing and looking down on it as it shrinks. And what you're doing is you're changing the modality of how you're looking at it. You're making yourself bigger than the problem, because in that moment, the problem feels bigger than you, but you actually have the power to like close your mind after you've done the walk and the focus on gratitude and helping somebody. Now you can visually shrink that problem down and feel 10 feet tall, bigger, looking down with your eyes closed, looking down at that small problem that you know you have all this evidence that you've overcome something like that before. So there's really no evidence that you can't do it now. You just have to ask yourself the resourceful questions, like, what must I do that I don't want to do? Who knows how to do this? How can I get in proximity to them? All of those effective questions versus why is this happening? When we ask, why is this happening? All we do is we get in this ruminating affirmation of, yeah, I messed up. So don't ask questions that start with why. Ask, how can I, what can I, who can I? Those are much more effective, powerful questions, and it'll change your vantage point and flip that problem on its back so that you're looking down and it's much smaller than you think.
Wow. That was pure gold. That was so awesome. I'm
Thank you.
definitely going to implement that. I like the walking part, going one direction, turning around, coming back. It's beautiful.
Yeah.
I
Sometimes I'm
love
like, walk for
yoga. So
20
it's like,
minutes.
I try to do yoga in the morning. I go to a class, they like crack the whip on us. But when they get into like the mindset type stuff like that, it really resonates. And I think what you just said is going to definitely go in my repertoire of getting myself clear and trying to focus.
I
So
love
I
that.
love that.
The hardest part of all that is just remembering when you're in it,
Yeah.
to remember that, oh my gosh, I have these resources, because you're overwhelmed by
Yeah.
whatever the situation is, to remember,
Right.
go start that process. Because you can totally change everything if you can just get yourself to move out of your way enough to help yourself.
Yeah. And it's
Yeah.
crazy. Our mind is so powerful. You can shrink that problem down and
That
put
was
it
a good way to
away.
put it.
Think about
Yeah.
something that was once true for you, but is no longer true. For example, I could say something like, I'm 21 years old. And if I close my eyes, I'll have a picture of when I was 21 years old. And I'll pay attention to how big is that picture? Is it in black and white? Do I see myself in the picture, or am I seeing through my own eyes? Do I smell anything? Do I hear anything? What does that look like? And since that belief is no longer true, I'm going to take the one belief that I don't want to be true anymore, like a fund is not good. And then I'm going to close my eyes and see the picture that I see, but I'm going to change it to the same modalities as the belief that's no longer true for me. And it pops that belief out. You can do it to yourself every day, all day. As soon as you identify a limiting belief, shrink it down and change it to a belief that was once true, but it's no longer true, because your brain literally does a file save as, and it saves it based on the modalities that are most important. So if you see through your own eyes, then you're associated in that picture. But if you see yourself in the picture, you're dissociated. So that could be a huge modality shift for you. If it's like, oh, okay, that's interesting. Let me see myself in the picture now. Maybe that'll make it no longer a belief. Maybe that's the thing.
Right.
So it's fun to play around with the visualization of it in your brain, and you can pop problems out all the time.
Very cool. We reached the top of the hour. Thank you so much for all your time and wisdom. That was incredible. Do you have anything you want to share with these guys to get in contact with you if they want to join your academy?
Well,
Obviously they can come to Raise Fest next week and see you.
Yeah,
live
definitely
in
come
person.
see us at Raise Fest if you can. If you go to warriorsofwealth.com, we have a curated playlist of our best like mini trainings that are there, and just walks through our entire blueprint for anybody that's interested. It's totally free. Just go to warriorsofwealth.com, or you can reach out and just like friend us, follow us, whatever, on Facebook, Jen Conkey and Stacy Rose Conkey. Those are probably the best ways.
Perfect. Well, thank you so much. We'll switch back to the green screen. Thanks to everybody that came on to the show today, and we'll look forward to seeing you next week.